For sure. And at this time, we'll turn it over to our next speaker, which is John Paul. So John Paul, if you want to do a quick audio test, and then we'll turn it over to you, and then he'll be followed by Bill Kostridis to talk about the night market.
I trade price action. I've been doing this for a very long time. I'm going to take us in a different direction. I actually want to show you a few things. I want to teach you the ABC pattern today. I also want to show you some tips on how I trade the news. So I am going to give you a little bit of an edge when looking for trends ahead of everyone else. So I am going to show you something that may help you when you trade. Now, a lot of what I do does not entail indicators whatsoever, and so I'm trying to simplify this whole trading idea of what we do. I don't want to have different time frames on my charts. I don't want to have multiple indicators. I want to keep this really simple, and that's really how I look at trading the markets, keeping it simple, understanding what we're doing. All right, so to start off here, a quick disclaimer. Obviously, everyone knows that trading is risky, so please do not trade with funds you cannot afford to lose. All right, if you have any questions on this disclaimer, please let me know. All right. Thank you, Jerry. All right, to start off with today's webinar, what I want to cover is price action trading, how we follow the price when trading. I'm going to show you a slideshow on indicators versus price action. I want to explain that to you. I want to show you that the only tools that we should be using and why we should be using them. Specific setups and entries. Yes, I do want to show you. I want to teach you how I look at everyday market activity. How we think as traders. Not every trader does everything the same way, but most traders do everything the same way. So let's distance ourselves on how everyone else is trading, and let's look at this in a more of a contrarian way. The ABC method of trading, I want to explain that as well. And last but not least, at the end, I want to show you how I trade the news, and what you expect doesn't always happen. All right? All right, the URL is DayTradeToWin. All right, Carlos? There you go. All right, so to start off here, this is an E-mini chart, March 6, 2012. Plain old chart with just price action. And this is using one of the indicators that I use. It's a proprietary indicator called the Atlas line. This is what happened on March 6th. But if you want to see what happened today, I always like to update my charts to show you what's happening in the now. This is today. Today we had, on March 20th, a long here, followed by a short. Okay, so just to show you how the market works, and not just trending days using something like the Atlas line, but also on days where you have an initial move and then it just starts to tailor off, and how we can accomplish that. All right, now everything you ever need is being played out as you see it on the chart. Everything. So having a blueprint in order to execute the trades is really the way to go. So if you don't have a blueprint on each step of the way, why am I entering? Do I understand the trade? Should I even be entering, for that matter? You should always have a blueprint when you enter into a trade. Trading price action is how successful traders do it. Nothing else matters. And I'll tell you why. When you're down on the floor, I've never heard a trader say to another trader, where's that stochastic? Or what's that moving average doing? I really never heard that happen. They could care less. They're looking at two things, price and time. And if you concentrate on those two things, on price and time, you'll be doing exactly an interpretive action of looking at the market and interpreting it. So successful traders do not look at the conventional indicators that most of the trading community looks at. And what is the price telling you? Most traders are looking at price and they're seeing it go up and seeing it go up, but most traders insist on doing the opposite. So what I want to say is, let's follow the price, let's follow the chart, and let's make sure that leads us where we want it to go. So the ABC pattern. Okay, I look at this every day. I break up the day into 3 very specific parts. The A part of the day could be 9:30 to 12 o'clock. The B part of the day is from 12 p.m. Eastern Standard to 14:30. And the C part of the day, the last part of the day, is from 14:30 to close. Now, I'm showing you an example of what I refer to as the E-mini open for New York time, Eastern Standard Time. But if you take this relationship of what I'm explaining to you here and put it on any market, whether that be the euro, when the London Exchange opens, the Life Exchange opens at 3 a.m. Eastern Standard. If you look at the euro, the DAX, the FTSE, the Australian dollar, the Swiss franc, any market, when it opens, the first 2.5 hours is the A part of the day. The B part of the day is from 12 to 14:30 or the next 2.5 hours. And then the C part of the day is from that point on till the close. Now, I'm going to show you specific examples of what I'm trying to explain here. But what is normal is that price trades within the range of A when trading in B about 85% of the time. This is what's normal. So when you look at the relationship of what happens in the A part of the day as compared to the B part of the day, what's normal is that the price ranges within the A part of the day about 85% of the time. Now, what I'm interested in is not what's normal. I'm interested in the difference when what's happening as we see it playing out is not normal. That's when about 15% of the trading year we see the B part of the range break out of A. This is where I identify a trend early and I'm able to take something out of the market because that's a very high percentage trade. This is January 3rd, 2012, first trading day of the year. Everyone was excited. Here we go. What are we doing? What's the new year going to bring? Well, let me show you how I marked out the day and what it led me to believe that the market was going to go much lower. It set off an early indication that we were going to close lower than open. From 9:30 to 12 o'clock, I have a range. I call this the A part of the day. When I see price break out of what you see here, right there, especially giving me a close, even 2 closes outside the range of A, this is telling me something. Typically, this only occurs 15% of the time when markets trend. This is an early sign that the market's going lower. My entry, second consecutive close outside the range of A, is what you see right here. That's March 3rd, 2012. You know what happened the following day? Here's the following day. March 4th, 2012. Here is 9:30. Here's 12. Here's my range. As soon as the market gave me 2 consecutive closes outside the range of A, what do I have? Proof. This only occurs when markets trend. And if I can get in as early as possible into this trend, I have a leg up prior to most traders looking at it as the trend is probably over. Okay? Now this is January 4th, 2012 on the E-mini S&P. All right, Katie? Now let's take a look at something a little bit more recent. This is what happens 85% of the time. March 5th, 2012, a plain old trading day, nothing special about it. Here's the range of A. You know what happened in B? Nothing. The B part of the day, which is from 12 to 14:30, was completely engulfed or stayed within the range of A. Therefore, I knew that the day that we're looking at is not going to be a trending day. Now I have hundreds of videos out there. You can take a look at the DayTradeToWin video site, or you can take a look at my YouTube channel. It's over 250 videos right now of me trading this and other price action methods, and you can see exactly how this works. All right, now just to recap the rules. A part of the day, it's the first 2.5 hours in the E-mini S&P, 9:30 to 12 o'clock. If you're looking at the euro for when the life exchange opens, if you're international, it would be from 3 to 5:30 Eastern Standard, let's say, the first 2.5 hours of the life exchange open. It's the same relationship. It's just the ABC pattern when that market opens or closes. All right, let's take a look at how we think as traders, how we trade, why we all make the same mistakes. Stops is a big deal. You not only have to know about your entries, but you also have to know about your stops. Now, how I trade, I use 3 different stop strategies. I'm not going into detail right now with them because I'm limited on time, but most traders place stops virtually at the same spot, and this is a mistake for a number of reasons. You can say they're running my stops, you can say that there's support and resistance and all this other stuff. You can give a million reasons, but the fact is most traders place stops where psychologically it makes sense, not where we should be placing stops as traders. So think about where you trade and where you put your stop. Think about your entries. Do you place your entries and stops at the same place as everyone else? Well, as an example, the majority of traders place stops and targets in similar price levels. I'll give you a perfect example. Fibonacci's. Everybody's looking at the same Fibonacci. I mean, wouldn't it make sense that there's going to be stops at all the same levels as everyone else is putting them? Highs and lows of the day, or prior day highs and lows, are also where most traders use stops. So if you think about this in trading terms, you have a group of traders that are all following the similar placement of entries and stops, and this leads to predictability. That's not how the market is. The market is not predictable. Okay, now let's take a look at this here. Let's say that we're having stops at 60 or at 50, for example. And we look at this number, 50, as a number where it's nice, it's round, it sounds good. You listen to the newscaster on TV and he said, you know, the market had a hard time going over 1200, they couldn't go over 1250 or 1300. These values that you hear are really a psychological way to say that's a point where the market should not go over, or I should put my stop at. I hear it all the time on the news. So instead, look at a situation where you don't put your stops at a nice sounding round whole number. As the market gets up there, this is not a place where you want to put your stops. This is just an example to show you where the market goes to, stops, and turns around at these round whole numbers, and 50 is the example here. Now, I talk about front running, and this is another example of front running, which is, you know, back in the 90s and early 2000s, even a little bit later when you talk about stock trading. This word front running is a bad word. Got a lot of traders in trouble. Now, I don't know anything about front running, just for the record, but I have to say that front running is one of the ways that you can get into a trade or get out of a trade before everyone else. Now, unless you have insider information, it's legal. If you have insider information, that's where the illegalities come in. So think about where we enter, think about where we exit. Front running, I'm going to explain here, is a situation where price goes to a value and fails, goes to a value and fails, goes to a value and fails. You can say it's resistance, you can say it's support. What I can tell you is that it's proof telling me that the market is having a hard time trading beyond 50. And if I have a stop there, or if I have an entry, I want to go long or short based on me seeing resistance. And it's not just by one candle. I have proof of 1, 2, 3, 4 bars there before it headed lower in the last bar. So this slide here is a combination of making sure you don't put your stops at a nice round whole number like everyone else does, 1350, 1250, those kind of numbers. And also showing you how front running a trade where if you wanted to go short, as the market goes higher, you want to take it short when you see this resistance building. It's not just by one candle. This is a grouping of candles that you need to see as telling you the market's turning around. All right? So front running a trade guarantees a fill when entering or exiting. Now this is March 6th, 2012. This slide here is showing you the example. As the market falls here, you can see the market try and fail to continue to the downside. Not just by one candle, which I think is irrelevant, but multiple candles. So I have here 1, 2, 3, 1, 2, 3, 4, 5, 6, 7. This is proof. And this is how I use price action. I don't use any type of Fibonacci's or candlestick interpretations. What I do is I look at price in a different way. What is it telling me? What is it showing me? And then how am I going to act on it? All right? Now, have you noticed the market lately? How slow it is? Especially the E-mini S&P. How are most of the indicators doing? I'm going to tell you. They've been chop, right? That whipsaw, making indicators almost impossible to use. So how can we trade this up-down motion where you have a pop, like a strong move, and it just slows down? Let me show you. This is a typical pattern that when you compare indicators versus trading what you see on the chart, how it makes it almost impossible to trade when it's slow like this, or even when it's volatile. For example, here's a timeline. We have in part 1 here, price moves up or down, and the candle closes. It really doesn't matter if you're using a 5-minute chart or an hourly chart, but price makes a move and it closes. After it's finished, the indicator interprets what just occurred and says, we're above zero, we're below zero, it's time to buy, it's time to sell, cross two moving averages with it, whatever the case may be. But what we fail to remember is that the move is over, right? The price bar has already closed. It's done what it had to do. Now the indicator is calculating based on a move that has already happened in history. Now, if we're in a trend, this is not a problem. But markets don't trend every single day. They go up and down. And if you're taking a trade based on what an indicator is telling you, you're always a step behind. Always. Take a look at number 2, and then take a look at number 3. Price is now on a new move. It's going up, it's going down, doesn't matter what it's doing. But it does something. And then it closes, the candle closes. And only at that point, the indicator looks at what just occurred, calculates again, and says, well, based on that move, now you should go short, now you should get out, now you should do something. But the move again is over. And this cycle just repeats itself. This is just an example of when you compare trading price and trading with an indicator, how you're always lagging a step behind. All right? So now what occurs in price? Watch how it moves and flows. I look at price every single day. I don't have 16 charts up. I may have 16 monitors, but I don't have 16 charts all running at the same time. Price action is more than just watching the price. You have to wait. You have to be ready. You can't be blind. More importantly, you have to ignore all other influences. So if you're looking at this and saying to yourself, the guy on the TV is telling me the market's terrible. Obama's going to go to Korea or to China to make a trade deal. And then you have somebody else telling you that the unemployment numbers aren't that bad. Ignore all those other influences. Look at what's happening on the chart itself, and then you make a decision based on that. Indicators that try to catch a move will always be behind. When price makes a move, the bar or candle closes in post, as I showed you. The indicator will always wait for the close of the move to calculate what has already occurred. And then plot some information. The move is over, right? Price is now moving into another direction. So let's follow the price here. Price is going up. What are you thinking as a trader? Obviously, most traders think, where am I going to sell it, right? Where's the top? Price is still moving higher, and you are still thinking of selling. It's normal, right? When I look at the market go higher, what do we say? Where are the Fibonacci's? Where is it going to stop? What's yesterday's high? What's happening at the resistance? You're always thinking about the opposite. The market moves higher yet, and you're not following the price. Instead, you're still thinking, where's the stop? Where's the top? Well, is the market telling you anything? Yes, absolutely. It's telling you it's going higher. So I want to look at what occurs with, as a simple approach, the market's going higher, you're thinking about a long position. If the market's going lower, you're thinking about a short position, unless something tells you otherwise. Will you buy the market if it's too high, or if you think it's too late? Traders normally don't enter the market because they think it's too high. Price is still moving higher, and you think, wow, I should have entered. You see the market move higher, and that gut feeling screams at you saying you missed the move. And then you enter, because finally you feel that it's time, that you missed the move, it's time to jump in on something. And now you enter, and guess what? You entered at the highest point of the day, losing out on the entire move because you refused to follow it as it began and started in the beginning of the move. The reason why I put this slide up here is I want to link it to a blog post that I did, and I have a very popular blog post, a blog on DayTradeToWin, where in January of 2012, there's a January effect that I talked about, that when I worked in the field, the analysts always talked about the January effect, how we look at the closing of January to tell us whether the year is going to be an up year or not. And so I said in this blog post, if January is going to be a higher close and open, look to buy the market because the year will end much higher than the January close. And this was middle of January. January 31st, I put another blog post out. We closed higher. It's time to buy the market. Unless you're looking for a better price or pullback, now's your chance. Look where we are now. Much higher than where January was. My feeling on it, if the market is pulling back, great opportunity to buy this market, hold it until the end of the year, whether you want to trade the September or December contract out a little bit. That's the way that I would play it. All right, so let's talk a little bit about trading the news. I want to end I only have about 6 minutes left. I want to show you really quick how I trade the news. Good traders never stay in a trade that goes against them for an extended amount of time. Limit the amount of time that you're in a trade. I call it a time-based stop. Also, professional traders never use the same tools as the average Joe to trade. Most traders look at the free tools that are available to them and they try to make sense of it. It's not how most traders that are consistently making money in the market look at trading. I want you to think contrarian. Don't follow the herd, leading you to slaughter. Chaotic markets. Why they occur? How do they occur? Why do markets become chaotic and volatile? Well, think about what happens during this kind of movement. You can't really trade that. Market will go up or down very fast, 5, 6 points, 10 points, right, when the news event comes out. But about slippage, is it worth trading during these times? I have to say no. When we trade during the news, oftentimes we as traders try to follow the crowd. I'll give you a perfect example. You look at that news event that comes out, whether it be housing, unemployment, or PPI, doesn't matter what it is. If it has a red star, a red flag, we follow it, and as soon as that number is good or bad, we initiate a move on that. Most traders do, at least. This is following the crowd. The news events do not always concur with the market action. As an example, when a positive news event occurs, let's say that the unemployment numbers are down, does that mean the market will automatically turn around and go up? I'm going to have to say no. Typically, it's not a hard and fast rule that you can say, that was a bullish economic report, guaranteed by the market's going to go up. I've seen it where it could go either way. It could be a good news event and the market tanks. So don't limit yourself to only buying or selling based on the news. Never assume that a positive news event equals a bullish move. Never assume that a negative news event equals a bearish move. Always watch for the calm before the storm. Price will begin to trade light, will begin to channel or range just prior to the pop. It's normal, expected, right? Most traders, they look at that and they're maybe they don't understand what's happening, but traders are pulling back, waiting for that big number to come out in order to say, I'm buying or selling. So it's normal to see that, expected. Countering the initial move, in my opinion, is the best option, but not blindly, always with proof. Let me show you. Never jump in with a market order. Slippage will kill you. Wait for price to come all the way back if you want. Wait for the pullbacks if price takes off. Never act on impulse or reaction. Very important. I'm going to give you something even more specific. Here is an example. I don't even know what day this is. February 25th, 2011. Last year, we had a GDP report at 8:30 a.m., a news event. First thing I want to know, was that candle chaotic? If the answer is yes, first part of the rule is has checked. If that candle is chaotic, the next thing I want to know is it a red candle or a green candle? Very simple. Is it red, bearish, or green, bullish? In this example, it's a red candle. You know how many traders sold this market based on the negative news or that candle being red? A ton. A ton. You know what that means? That if that move is wrong, and if that move turns around, you have a huge amount of traders that are going to get stopped out. Okay? And when that occurs, it will fuel the market in the opposite direction. Not just because traders are getting stopped out because they were wrong, because there's a lot of traders now jumping on board, hitting that reverse button, and going long with it. This is the result of what happened when you have a bearish news event where traders go short thinking that they've hit the gold mine and this thing turns around. Here is a telltale sign that it's working. You see how big this candle is right here? If you can see that? This is the stops getting hit. They got to cover their shorts. They just took off. My entry on this, 2 consecutive candles that close above the high of this red bar. It's the absolute opposite if you are looking at a bearish move. I've got about a minute here left. Power price action, day trade to win. I have multiple products. They all base themselves off of price. 4 DVDs plus 8 weeks of training with me is a new program that I have. It's been very popular because it includes the 8 weeks of training. Check it out. Take 10% off by using the coupon code NinjaTrader. You can always email me at support@DayTradeToWin.com, or you can visit the website if you have any questions on anything I've shown. Eddie, I'm going to hand it over to you. Thank you, guys.
All right, great. Thank you very much.